Very good evening, everybody. Welcome to Trading Opportunities in Palm Oil and Palmolene, a Phillip Futures webinar held in collaboration with Dalian Commodity Exchange. I'm Ming Hui from Phillip Futures, and with the world's largest RBD Palmolene futures approved for foreign market participation from 22nd December this year, how can investors like yourselves do so, and what are the trading opportunities in store? Stay tuned as professional proprietary trader David Ng shares key insights with us in a bit. First, let's hear directly from DCE representative Josh Chow as he shares with us an overview of the DCE palm oil futures market, DCE's future development plans towards internationalization, and more. Do be reminded that if you have any questions for the speakers, you can send them to us via the questions box, and we will address them during the Q&A session towards the end of the webinar. And now, without further ado, let's have Josh speak to us.
Good evening, everyone. This is Josh from DCE Singapore office, and thanks Phillip Futures for setting up this webinar, giving me the opportunity to share with you guys about DCE's palm oil futures and also some basic overview of the exchange. With the internationalization just less than 1 week away, I believe everyone is excited as I am. So today is just a brief overview of the exchange and the palm oil futures. DCE, currently we are one of the 4 commodity exchanges in China, and now we have 20 futures and 7 options. That covers grains, oils, and also energy and petrochemicals. Over the year, with the development of the new products and our marketing, our market overall volume has seen really rapid growth, especially in the recent years, as you can see in this picture. And last year, DCE was ranked number 11 by the IFIA World Exchange Ranking. So that's right after Shanghai Futures Exchange. And now currently DCE is the largest coke, plastic, oils, and oilseeds futures market. Also, DCE is a benchmark for the iron ore futures as well. And overall structure for DCE, there are 163 domestic members, and we currently have more than 300 delivery warehouses across China, and there are 16 banks that work with us for the transfer of money, and you can see in this picture. Okay, next let's move on to the palm oil futures. This is a contract spec of the DCE's palm oil futures. Some things to note here is that the contract size is 10 tons per lot. That's different from BMD's FCPO. And the price and also settlement are all in Chinese yuan. Also, the contracts month are 12 months, 12 months of the whole year. So and the clients can trade up to 1 year from now. The trading hours are there are now 3 sessions in the morning, afternoon. Also, there's a night session from 9 to 11 p.m. And some quality standards are it's 24 degrees Celsius palm oil, and you can see on the right hand side of this picture there are some other specifications of the qualities. So this graph shows some price movement of DCE's palm oil against BMD's FCPO. As you can see, the 2 contracts are really highly correlated with a correlation of close to 1. And because the two products are quite different, related, and they are in different locations and denominated in different currencies. That could give traders a good opportunity to hedge as well as to arbitrage between the two markets. Since last November, the volume of palm futures has really picked up a lot. And so far this year, I believe palm futures is the top three ranked futures of DCE, right after soybean meal and iron ore. So recently, every day, about 1.6 million contracts are exchange hands. That converts to 16 million tons per day. So the contracts is really liquid. For the investors structure, in the trading volume, they are mostly by the individual clients, but do know that some of the individual clients represent a corporate because there are tax incentives and benefits for individual clients. But for corporate clients, they need to pay tax on their profit. But if you look at open interest, is more than half of the open interest are held by corporate clients. All right, internationalization. So palm future will be the 7th internationalized products of China, and it will be the 2nd from DCE. So basically, overseas clients have two ways to access to the internationalized palm futures. The first way on the left of this graph is overseas clients can directly contact one of our 160 members to open an account in China. In this way, they need to set up their bank accounts in China too. It's a little bit complicated this way because it requires more communication and sometimes even traveling to open accounts. That's why 80% of the accounts are open in the other way. That's on the right-hand side. You can see an overseas clients can open account with one of DCE's overseas brokers who has entrustment contract with one of our members. And so far, there are already 59 overseas intermediaries from 10 countries and regions in the world. That includes many of, I think, 11 of them in Singapore, including Philip Futures. And currently, we have more than 300 overseas accounts open from 21 countries and regions. Most of them are currently trading iron ore, and so the internationalization process from DC is really successful so far. And we're really looking forward to see more traders participating in the palm futures as well. Okay, about margins, that's something overseas clients care a lot. Because the contracts are settled in RMB, everything is in RMB, but DCE does accept other collaterals like US dollar. However, I think for overseas clients, you can always talk to your brokers to deposit other currencies to be used as a collateral. And yes, that's basically it. And for the profit, there are two ways. So a client can choose to use RMB as their profit denominated currency or US dollar. If a client chooses US dollar, the profit will be converted to US dollar on a daily basis. Oh, by the way, currently the minimum margin charged by DC is 8% of the contract value. So it's not by spend system. It's DCE charge a fixed percentage of the contract value as margin. And that's basically and something about DCE's future development. And first, palm options is on the list. It's on our list, so we are studying it on it, and we'll probably launch it sometimes next year. And I believe internationalization of the palm options would also be really soon. And also, this is working on getting more liquidity on all the contracts. Some of you might be familiar that in the Chinese commodity markets, especially in the agriculture, there are January, May, and September contracts that are most liquid. So we are working with market makers, and also we selected some warehouse receipt providers to make sure that the contracts, the futures are liquid across all the contracts, and also improve delivery mechanism. So currently, the international participants are not able to deliver physical palm oil against the exchange. So that's something we're working on. Probably in the future will allow foreign participants to deliver, and also maybe setting up delivery points overseas. On a broader points of view, so for DCE, there will be more internationalized products coming, including the soybean complex that may provide overseas clients with more hedging and trading spread opportunities. Also, QFII and RQFII access. DCE is currently working hard on getting QFII and RQFII open to mostly all of our products, so that overseas traders can trade a wider range of products. All right, that's end of my presentation, and please feel free to contact me and to follow us on WeChat and LinkedIn for the latest updates from the exchange. All right, thank you.
Okay, thank you, Josh, for the introduction to DCE RBD palm oil contract. I'm on my part, I'm just going to touch on the trading opportunities of palm oil and palm oil. Given that both these products are very similar in a sense that palm oil is actually a byproduct of palm oil. So if you are someone that's trading on a palm oil market, in fact, I think palm oil provide you an opportunity or even an avenue for you to look at in terms of opportunity trading opportunities. Firstly, just like thank Phillip Futures and DCE for hosting this platform. I think in fact it's quite timely given that both commodities has actually reached an 8-year high, especially for BMD prices. And it's going to be very exciting times ahead, given the fundamentals which I'm going to share later part of my slides. And we're going to see on how things are going to play out in next year, especially on the first half. So just a preliminary, I think any materials here presented here today is purely on educational purpose. Do speak to Phillip Futures to find out more on the product itself, or even in fact some of the deeper information that you require. So I'm just going to start off with giving you a general market overview on what happened on especially on the BMD prices as well on the DCE RBD prices as well. I think this year has been very exciting. Given though that we are in fact in a pandemic year, we have seen volatility in a lot of major asset classes. I think commodity was not an exception. So if you see prices, we have seen the trough, we have seen, now we are probably going to see the peak very soon. But I think the rally they are seeing is in fact phenomenal. I think we do have to watch out on fundamentals as it play out. And if you are trading on the market, it's something that we have to watch out closely. And obviously, both DCE and BMD are very similar in terms of the products, the characteristics as well. So analyzing both products in terms of fundamental perspective does give a lot of relevance when you're trading the market. So I'm just giving the lens of a trader where we can see or where we can assess in terms of the fundamental aspect whenever we are trading these two products. And last but not least, I'm going to share with you some of the seasonality in play, for which are the particular periods of months where both products display strengths and weaknesses. So that's where we can capitalize on the differences in terms of the seasonality, and usually that's what traders will normally look out for. And I'm just going to share with you, obviously, the intermarket spread between the DCE and the BMD price, because I think spread itself does give you information on how both the markets will react. And as a trader, you also have to be very mindful if you are looking at spreads, because it does give you an indication where a particular market is going to hit. So I'm just going to share that as a later part on the slide. So first thing first, I think the general market overview, I think it's been very volatile here. In fact, if you just look at BMD prices for the past 5 years, you have seen that they have just broke the 3 years range above the 2,600 ringgit per ton. And we've seen a rally above the 300 and it's been sustaining at those prices since then. It indeed is a very remarkable recovery. We have saw how the pandemic effect has actually caused a slump in prices, both the DCE and the BMD prices as well. We have reached a low of 1,900 just early part of this year, mid-March, and prices has since then recovered tremendously. And obviously, there's a couple of factors that's actually leading to it. Obviously, fundamental demand factors has actually changed to be very bullish, starting around September onwards, coupled by lower stocks levels in Malaysia. I think that rally is mainly supported by lower stocks. And obviously, as a trader in commodity space, it's actually very important for us to assess the wider statistics, especially when you look at palm oil, for example. I think if you look at some of the MPOB figures which publish on a monthly basis, palm oil as a price effect is very sensitive to stocks levels. So obviously, when you are seeing conditions where lower stocks inventory, lower stocks piles in general, obviously prices will tend to rally. So fundamentals are in fact very bullish right now. But I think as we go into the first half of next year, 2021, there's a lot of questions that's be lingering in the market. First thing first, whether demand can be sustainable, whether production trend will start to pick up. So these are the key questions that, as we head into next year, we should remain in our objective. So these are some of the brief dynamics of prices. So first half, we have seen prices slump to below 2,000 ringgit per ton, given the fact that a lot of major countries are in a lockdown. We face demand destruction across the board. So obviously prices would stay below those levels. But things start to change when July onwards as economy starts to reopen. So we've seen recovery in demand. And the shocker was that La Nina came into effect probably around early September. So that causes the production to slump even further. And compounding that effect is that if you look at some of the production numbers in Malaysia, especially East Malaysia, those numbers are below expectation for the fact that some of the plantation estates they face a lot of labor shortage issues as a result of the pandemic. So I think given the onset, prices would just have to head further north, given the sets of bullish fundamentals. And obviously, I think the weather risks still remain very relevant. But obviously, when weather starts to slow down a bit, I think that's where we should be cautioned. Given the fact that we are, BMD prices has been 8-year high, and whenever you see prices at 8-year high, usually you should be very wary. Now, going into statistics, if you look at Malaysia palm oil stocks, this year has been very phenomenal. We have actually, in fact, sustained below the 2 million metric ton figure for quite some time. And in fact, that's the reason why market has been very bullish. We have not seen those numbers for like 4 or 5 years ago. So in fact, this year, Malaysia itself, discounting Indonesia numbers, Malaysia itself is experiencing a very tight supply situation, given the low stock levels. Now, if you look at production perspective, production same goes. We are clearly seeing, despite early first half, we are seeing strong production, but it tapered off around May-June period. So production, in fact, is way below expectation. As the two reasons I mentioned. Firstly is given the labor issues that we're facing, and secondly is the La Nina weather that's into play. So production seems to be way off expectation, but we have to be cautious as things start to pick up early next year. Production may tend to pick up in a quite a gradual manner. So if you are trading the market, do watch out on this space. So once production starts to pick up, inventory starts to pick up, I think prices will tend to correct. So I think the key reasons for such a huge rally that we're seeing in both markets, especially on the BMD market, is for the fact that Malaysia has been facing a very low stock level this year. And obviously, let's just look at those numbers. I think this year, as a year-on-year average, we're looking at about 30% lower than last year. That's a lot. And I think, in fact, if you just look at last month's MPOB figures, for quite some time, we have seen Malaysia starts to import from Indonesia, but those numbers are actually very small. But last month, you saw an increase of 100%. I think that's phenomenal. That shows that Malaysia's situation is actually very tight. We have a very low supply, but demand are still keeping pace. So I think whether this situation will change is much remain to be seen. But as a trader, we should watch out on upcoming MPOB figures, especially on stocks and production numbers. So here I chart Malaysia stocks levels by MPOB against the Thailand DCE RBD palm oil prices. So you can clearly see there's an inverse relationship here. So whenever stock levels are high, and obviously prices will tend to be on the low side. And when things start to change on the stock side, that means you face lower stock levels, prices tend to be more bullish. So currently we are in a situation where prices is in a massive rally. Stocks levels are reaching a 3 to 4 years low. So this is a situation that we are facing, and obviously going forward, stocks figures are something to be very closely monitored, because prices will tend to be react very sensitively to stocks figures. Now that's on production and supply fundamentals. Let's look at the demand fundamentals. Now the two key major buyers, China and India, is always the largest buyer of Malaysia palm. And if you just look at China itself, I think early this year, we were facing the onset of the COVID crisis. Obviously, demand will probably tend to softer. India, in fact, as well. But things start to change around June, July. I think India and China starts to pick up around the second half as economy starts to reopen, as certain cities are coming out from a lockdown. Obviously, those demands are very strong, and also that push up prices even to higher levels. Now, the question always remains is that will this demand be sustainable? Now, the way I look at it, it seems like December numbers are going to be good, given the fact that Malaysia has actually imposed a 6 months moratorium in terms of tax. But coming January 2021, the export tax reimposition is going to be back. I think a lot of exporters are taking the opportunity to be exporting back into the market during this window. So watch out for numbers coming in the next 2 weeks. Likely China and India is probably going to purchase more before the tax window starts to kick in. And if you look at some of the cargo service numbers, in fact, it actually reinforced the opinion that India and China is actually trying to buy before Malaysia starts to impose tax back in January 2021. And I think if you just look at China's situation in terms of demand side, I think palm oil stocks level at their ports still remains relatively low, lower than average. So that suggests that China will still continue to buy. Obviously, certain importers are very price sensitive. If prices continue to rally, in the market, I think importers tend to hold back. And obviously, there's also other edible oil markets that's also competing with palm oil at the moment. So I think even though we are seeing low stocks levels, prices is definitely going to be an equation. But this suggests that China can continue to buy more palm oil from Malaysia, just to fulfill some of the stocks inventories at the port. Now, here I chart the relationship between soybean oil and DCE RBD palm oil. So you can clearly see there's obviously a very close positive relationship. The strength of the co-relationship is lesser compared to BMD palm oil, given the fact that palm oil and palm oil are actually both of them are in similar complex product. But RBD palm oil and soybean oil is a is in the edible oil category. So obviously prices move in tandem. So it gives us an opportunity. If you are trading the market, you can always use one of either market as a reference point. And if you just look at the opening hours and the closing hours, night sessions on RBD palm oil can have a lot of distinction with soybean oil. So it has a co-relationship in that sense. So if you are trading on a night session on RBD palm oil, do have a look at soybean oil as well, because the price performance do dictate to a certain extent how RBD palm oil is going to move. So as someone that's trading the palm oil market, it is very important for us to look at spreads. And here I chart the spread between the palm oil, RBD palm oil, and obviously soybean oil. All of these are actually in the edible oil space. Now, palm oil and soybean oil spread has been a very common market, reference for a very long time. And you can also dictate the relationship with RBD palm oil, given the fact that RBD palm oil and BMD are very closely linked. So you can clearly see that the current spread between both palm oil complex against the soybean oil is actually on a very tight discount. And when you have a situation where it's on the discount market, which means that soybean oil is cheaper relatively to both the palm oil and RBD palm oil, then we're going to have a situation where we're likely to see weaknesses in the palm oil market and strength in the soybean oil market, because we have seen historically that whenever the spread goes into a discount market, where it goes into below the zero line, that situation will not last long. In fact, the market will quickly readjust because as importers are starting to demand more soybean oil because it's relatively cheaper, and that situation will quickly reverse. So that's what we are seeing right now. We are seeing, soybean oil looks like it's relatively cheaper. But just yesterday prices, I think soybean oil has actually rallied more than close to 2%. So hopefully the discount has actually turned into a premium, and let's see whether the premium can continue to last. Now, as an average reference, the average price spread between the soybean oil and the palm oil market, or in fact even the RBD palm oil market, has been always the $100 mark. So we are way down right now. We are way down below, given the strong fundamentals in the palm oil market. So another interesting relationship here is to compare the palm oil and gas oil relationship. So obviously we have seen the slump in demand early part of this year. Crude oil prices actually in fact went into a negative territory. So that's another interesting development. So that spells that the demand for biofuel is going to be very weak, because when you have high crude oil price, obviously there's a lot of incentive to do biofuel program, which you blend your gas oil and palm oil together. Now, given the fact that you have seen very low crude oil price environment right now, so it's very difficult for countries such as Malaysia and Indonesia to really go full swing into the biofuel program, because we are facing a tight supply. If you go into biofuel program, it's just going to exacerbate the situation even further, and that's going to cause stocks to plunge even further. So prices just going to go even higher. So I don't think that's very feasible. I think Indonesia has taken steps to probably try to reimburse some of the biofuel producers just to get the program continue. I think with low crude oil price environment, and you just look at the palm oil to gas oil spread right now, is actually in fact negative, which indicates that there's not much incentive for biofuel producers to blend gas oil with palm oil for the moment, unless we are seeing a swing in situation. There's more upside in terms of crude oil prices, then probably we should see demand coming from biofuel starts to re-emerge, and that should support market going forward. But right now, we don't see the kind of demand yet, and I think that's something to watch out for going forward. Now, as a trader, I think seasonality is very interesting whenever you trade commodities. Palm oil and RBD palm oil is no difference. Now, apologies if you can't see the figures because I took it on a picture format, so it's actually blurred some of the numbers and the figures. But I just want to emphasize on the color that is being represented here. So if you look at it, red color means it's a month-to-month change negative. Green color means it's a month-to-month change positive. Now, this is drafted on a 10 years data. Now, I just want to bring your attention to months which is you have a lot of green boxes. Now, if you look at palm oil for the past 10 years, you can clearly see that October, November, December, which is the last quarter of the year, you usually reflect strong prices. As we only have 2 more weeks towards the end of the year, I think likely palm oil is going to close higher month on month. So this reinforces the fact that we are entering a season, a period where prices tend to be strong. Now, if you reverse that scenario and you look at it and you assess the seasonality in terms of months which are weak or months which have a lot of red boxes, then you can clearly see May, June, July are usually periods where it tend to be weaker compared to other months. And that actually reinforce or coincide with periods where production starts to pick up. So it's very crucial to watch March, April, May next year. Are we going to see a similar trend? It is very likely, barring any unforeseen weather circumstances. But I think given current scenario, we're likely to see production tends to pick up next year March. So the recent rally, there's still a little bit of upside, but that upside window is slowly going to diminish. So as a trader, I think seasonality in commodity is actually very interesting because commodity prices tends to react seasonality as compared to other asset classes. So this is on RBD palm oil. Again, it's a very similar trend. You can clearly see October, November, December, it is strong in prices, and your May, June, July is where your weaker prices tend to react. So if you are trading on RBD palm oil, it's also good for you to reflect on the seasonality for based on the historical pattern. Are we going to head into a stronger period or are we going to head into a weaker period? So if you are a trend trader, be reminded that when you are heading into a stronger period, you should be having a view or thinking of entries to long rather than thinking entries to short the market or be a contrarian, because when the trend comes, it really comes in full force. Now, I'm just going to show you an intraday chart between the CPO, the BMD CPO, and the DCE RBD palm oil. So you can clearly see, given the different market session between the BMD and the DCE, one can actually capitalize on certain market movement. So if, as you know, BMD opens at 10:30 and it closes at 6 p.m. and after that, it has no market until the next day. Now we have a night session on the DCE palm oil. Now that's critical in a sense that if you are having a position on BMD and you tend to hold it and you have no way to hedge it, you can probably use the DCE palm oil to hedge your position, because you have a night session market for you to counter react any effect that is against your position. A scenario could be any developments in the soybean oil market, especially coming at night during Malaysia time. It's going to have an impact on BMD the next day. So I think it gives a lot of flexibility if you are trading the market to give an edge on how to hedge your position, especially when you are being exposed in off-market session. So if you are trading BMD, you can complement your trading with DCE palm oil, obviously to a different night market session, which I think RBD palm oil night market is quite coincide with the soybean oil price movement, which I'm going to show you in the next chart. So here you can clearly see SBO is representing your soybean oil, and PO is actually your DCE palm oil. So you can clearly see the movement are very similar. They move in tandem. As I said, both are in the edible oil market space, and there's a lot of regularity and the correlationship between both products. So if you are a trader that you caught long or short in your position during the BMD session, you could hedge your position through the DCE palm oil, because that will counter react any effect, especially on the bean oil market space. So I'm just going to share with you a very simple technical setup, which I normally use when I trade the palm oil market. And when I looking into some of the data that is on the DCE palm oil and I reflect that on the DCE palm oil market space, I can see that it's a lot of relevancy and you can achieve a lot of objective from here. So I think first thing first, whenever we look at setup, it's always very important for us to establish the longer term trend of the market. And how we do that is to look into the 200 exponential moving average line. So the 200 exponential moving average is sort of like a market convention to see that whether the market is on the upside or on the downside. So as long as the candles are above the line, we are probably in a market of a bull market. And as long as the candles are below, that means that the market is actually on a downtrend or on a weaker side. So 200 EMA line doesn't only just tell you whether the market is on a bull run or is on the downtrend. And in fact, it also provides you a very strong support and resistance line. So right now you can clearly see that the RBD pump volume space is in fact looking at a very strong bull run, coincide with BMD prices as well. BMD market is also on a very strong bull run right now. Now, I think another important indicator which I use, especially when I trade both markets, is to use the Heikin-Ashi to identify trends in an easier manner. So, if you are a trend trader, identifying trend can be quite hassle. So Heikin-Ashi actually simplified that task for you. It's a bit slightly different from your normal Japanese candlesticks in a way that Heikin-Ashi takes the average of your Japanese candlesticks. So there's a mathematical formula to it. It's in a way, in other words, objectifying your Japanese candlesticks. So the way to look at it, to illustrate a particular trend, whenever you see a sequence of green candles on a Heikin-Ashi bars, that indicates that the market is on an uptrend. And when you see a series of red bars, then that's a sequence of a downtrend. And when you don't see any clear colored bars, whether it's green or red, it's all mixed up, probably the market is actually on a consolidating basis. So obviously you can fit this into a particular time frame. If you're an intraday trader, probably you're looking at about 30 minutes. If you are someone that is, a trend trader or a swing trader, probably you're looking on a daily basis. So now to put into practice, this is basically the RBD palm oil prices. So you can clearly see incorporating Heikin-Ashi, you can clearly see the trend is on the uptrend and trend is on the downtrend. So on the uptrend, you can clearly see series of green candles that is subsequent, and that shows a very strong uptrend. Same goes vice versa. If you see a series of red candles and those candle bars are very long, that shows that the market is actually on a bearish mode. So in those markets, you should be shorting, and in green markets, green sequence markets, you should be longing the market. Now, Heikin-Ashi itself may not provide sufficient entry signals or exit signals. You can accompany that by moving averages. So here I actually imputed the 9 and 20 days exponential moving average. The reason I use exponential is because it tends to reflect faster in terms of prices. So it tends to react to prices in a faster manner. So whenever I use moving averages, you are just concentrating on the crossovers. So if your shorter term crosses above your longer term, that means the market is bullish. And if the shorter terms EMA is crossing below the longer term, that means the market is bearish. So now here you can see that if you accompany Heikin-Ashi bars, which you see green candles, and you accompany by moving averages crossovers, you probably could have a very good signal, entry signal over there. So you can accompany this in part of a technical trade setup whenever you trade both the markets. Now, I just want to share with you in terms of volatility for both markets, because given the fact that we have seen a very strong correlationship between the RBD palm oil and the BMD palm oil, obviously the characteristic risk profile is slightly different. So if you look at this is based on 30 minutes time frame, and I use average true range as a measure of risk or volatility. So you can clearly see BMD display a lesser volatility as compared to RBD palm oil. So in most cases, volatility in RBD is likely to be 2 times greater than BMD. So as a trader who loves volatility, I think RBD palm oil contract seems to offer you a bit more opportunity as compared to BMD. BMD is slightly less volatile, but in recent times we have seen the volatility is actually starting to pick up. So both markets actually offer you a very good, tremendous opportunity. Now, here I actually impute the spread between the intermarkets, the DCE palm oil as well as the BMD palm oil. So you can clearly see if you normalize it into single currency, because both the markets are denominated in different currencies, So if you regularize it into US dollars terms, you can clearly see at certain point in time the spread between BMD and DCE is about 300 US dollars. And those spread has actually narrowed recent times because the rally in BMD, it was quite measured. And I think, palm-oil, the DC palm-oil contract failed to capture that momentum. Now, as a intermarket spread trader, this is a good opportunity. If you look at historically speaking for the past 5 years, every time when the market spread hits about 300 US dollars price difference, that's where a lot of market arbitragers will come into the market and to arbitrage between both markets. So right now we are probably seeing no spread between the 100 to 150 price level. And if you look at the upside of this spread, the $100 is actually considered very expensive. That means the BMD upside seems to be quite limited because eventually the Thailand palm oil is going to catch up. So the intermarket spread shows you there's a range that the market is trading between the 100 US dollars and the 350 US dollars for the period of 5 years. Obviously, if you're a spread trader, the spread can break above those ranges. And usually it's reflecting fundamentals. So right now, you can clearly see that the BMD prices are slightly more expensive as compared to DCE. But eventually, I think DCE prices is going to catch up. So there's only two things that's bound to happen. Either we are seeing weakness in BMD shortly, or we should see some strength in DCE. So as a conclusion, I think first half you have seen, I think first half of this year has seen weakness, and we have seen tremendous recovery in the second half. Now, first half next year is going to be very crucial, and I just highlighted the fundamentals. Whether the fundamentals can still persist into next year is still questionable. Obviously, we have good fundamentals in this season. We are not sure whether it will overlap into next year. So keep a watch on prices because as we have seen, whenever prices are rallied into this kind of extent, they tend to have a retracement. It's a question of timing. So be very wary because the current rally they are seeing is we are almost at 8-year high on BMD prices. So I think that's something to watch out for. So I think the current, if you just based on fundamentals, the momentum is still bullish. The short-term rally can still remain in play. I think if you just look at technicals perspective, I think near month or BMD contract could easily reach the 3,800 ringgit per level. But that again depends on fundamentals. Are we going to see lower stocks in coming months? I think that's a key question that we should be watching out for. So on the DC perspective, if we are seeing higher BMD prices, then DC palm oil should be able to trade above a very key crucial resistance level, the 7,400 Chinese yuan prices. So if it does hit above that, I think it's going to take it to the next level. So obviously BMD prices is also going to reach to a next level. I think last but not least, I think weather has been very strong factor in terms of boosting prices. Now, a lot of market has anticipated that the weather effect will start to wear off. And in fact, whenever you see La Nina events, which we are in right now, we have seen prices tend to rally, but eventually prices tend to correct very fast because on the onset of La Nina events, we usually see yields starts to increase, given the fact that you have trees just react in such a manner. So we just have to be very careful going into first half of 2021. Do watch out on key fundamental factors we have just highlighted because those are the things that can really change the sentiment altogether. So with that, I'm just going to pass it to Ming Hui for the Q&A, and that will be my conclusion.
All right, thank you, David and Josh. We're now moving on to the Q&A segment. So do send in your questions for the speakers via the questions box. And our first question for the night is to David. David, how would you utilize the Malaysian crude palm oil inventory levels and the BMD CPO prices as a reference point to trade the DCE palm oil contract? Any pointers?
Yeah, okay. I think that's a very good question. Now, if you just look at the price behavior between DCE palm oil and BMD palm oil, it's actually very similar. Now, obviously, with the different opening hours, DCE starts earlier, BMD starts later. But in certain trading days, or in most times in general, when BMD market opens, you can clearly see DCE will start to trend according to the overall trend in the BMD market. And BMD market, being like a price leader, is very sensitive to fundamental nature, especially with stocks. Obviously, we are in a period of low stocks level, and that actually causes prices to be on the stronger side. So in other words, DCE Palmolive should also be quite price supportive. So I think as a trader, that's how I look at it, as a totality, that how each part's instrument influence the other part of instruments.
Okay, the next question is also to David. It says, I noticed that the DCE Palm Olein futures contract has a high intraday volatility. Do you have any tips for risk management?
Yeah, that's a very good question. In fact, I didn't incorporate in the slides about risk management. And it's definitely a must if you are trading any types of market. You must have a proper risk management. Now, I agree. If you just look at on the basis of comparing both products, DCE Palm Olein does display higher volatility on the intraday basis. Now, if I were to trade the market, I think it's very important for you to use average true range as part of your risk management. Average true range provides you the daily volatility in terms of particular product. If I'm not mistaken, I think DCE Palm Olein ATR value is about 100 to 120 ticks. So if you every time you manage a trade, you enter into a trade, you should, if you work on a 2-to-1 risk to reward ratio, you should have probably 100 to 120 ticks stop loss from your entry point. I think that's how I will manage it, because it's definitely a highly volatile market.
Okay, thank you. The next question is for Josh. The audience would like to know when DCE will likely internationalize the soybean complex. And what about agricultural contracts like corn? Are there any plans to internationalize that in 2021? And lastly, is there an inbuilt calendar spread feature for the DCE Palm Olein contract?
Okay. Yeah, thanks for the question. For the next internationalization progress, I believe we'll see some products in 2021, and it's very likely to be one of the soybean complex. It's either soybean oil or soybean meal, or it could be both of them. So keep looking forward to it, and I believe at least one of them will be internationalized in 2021. And also for the second half of the question, yes, DCE does offer calendar spread. So it's but the calendar spread is not a contract of a spread contract, but it's a way to put in your order, so you can buy the January, sell the May, or the other ways. So it's a simultaneous two orders at the same time. I hope that answers the question.
Yep. Thank you, Josh. The next question is to David. Besides tracking the Malaysian crude palm oil inventory levels, BMD CPO prices, is there any fundamental factors that might affect the DCE Palm Olein contract? Can I employ technical analysis and trade it off directly?
Yeah, I think that's a very relevant question. I think firstly, if you are trading the market, as a trader, fundamental does paint you an overall midterm picture. You just have to cover some of the key supply and demand dynamics. Stocks being one of it, production being one of it, demand being one of it. So I think MPOB monthly published by Malaysia Palm Oil Authority, I think that's sufficient enough to give you a very overall fundamental picture. Now, I think when it comes to trading that particular product, I think technical perspective is sufficient. Just keep in mind that whenever you are, whatever trade plan you are employing, do make sure that you have a proper risk management. Then obviously keeping in mind what I just highlighted, some of the fundamental factors as part of your trading equation, I think that's going to be quite comprehensive.
Okay, thank you. The next question is also to David. It is soybean oil futures in CME strongly correlated to BMD, CPO, and DCE palm?
Yes, I don't have the figures offhand, but CME soybean oil, I think has about roughly average about 75 to 80% correlationship, and obviously, BMD and DCE has about 95 to 97% correlationship. So the edible oil market space, all these three oils move in tandem. So whenever you are looking at the strength, I think BMD and palm oil is naturally is stronger compared to soybean oil, but it does have an impact. Like I said, if you're monitoring the market, especially on the DC palm oil, the night market session, it has a very strong relationship with the bean oil performance on the CME.
All right, thank you, David. The next one is also to you. With reference to your 10-year heat map on crude palm oil prices, do you reckon that it's a good time to take a short position on the DCE palm oil in March 2021 contract? And is there any fundamental reasons behind this?
Okay. Yeah. Now, if you look at the heat map which I presented here, the heat map refers to not the contract month per se, but it's referring to the month itself. So if I'm not mistaken, I think the active contract on DCE is always on the 5th or 6th month. So right now, I think May 2021 is the most contract that has a higher volume. So as we reach into probably March next year, and I think that's where fundamental will start to change. So I think year-end contracts on DCE at the time will probably be the active contract, and those are the contracts that you should be paying more attention to. So I think do watch out on the fundamental space before we make a judgment on whether the fundamental tends to change. Like I say, I think December, January, February window, it's still pretty much tight in terms of fundamentals. Obviously, historically, if you look at the heat map, March where things will start to change. But you know, there's a lot of market talk that production may even be lagged until May, June, July period next year. So I think this is something that we need to take note of.
Okay, thank you, David. The next question is for Josh. It says, if we treat calendar spreads of the DCE palm oil contract, are we entitled to margin offsets? And do we get lower initial maintenance margins for having a simultaneous long and short position in the DCE palm oil futures contract?
Yes, the short answer is yes, you do have a margin offset on the calendar spread. But it's not a straightforward calculation. So every day DCE will post the margin requirement on certain spread and also arbitrage positions. The margin requirement will be published on our website. So it's kind of not a straightforward calculation on the margin, but you do get some margin offset. The less money is required for trading that. And for maintaining the position, is as I said, the DCE's margin mechanism is a straightforward percentage of the contract size. So basically, the margin level will remain the same. Yeah. If you have just a long or short position.
Okay, thank you, Josh. This next question is to David. With reference to the DCE palm oil futures contract, what is your preferred trading strategy? Would it be to take an outright position instead of calendar spreads since there is strong intraday volatility?
Yeah. Okay. That's a very good question. Now I mean, to be very honest, I think calendar spreads because DCE at the moment does not have an exchange listed calendar spread. It's based on a synthetic. So I think it obviously based on the platform that you're using. That's one consideration. I think another thing is that doing outright gives you a better management at this point in time, because the spreads behavior on the DCE And if you look at on BMD, if you're trading a BMD market, it's going to be slightly different because the mechanism and the behavior is totally is a different market altogether. So I will caution for the time being, if you're really looking to calendar spread on a DCE, because you're going to be entering a synthetic spread instead of an exchange traded spread. I think that's one equation that you need to take into account. So obviously, I think the key main focus is to look into opportunity on the outright basis. And I just highlighted based on the intraday volatility, and if you just embark on some of the technical setups which I just highlighted, the Heiken Nashi, the moving averages, I think that will be sufficient for you to point to an entry and exit. With a proper risk management. So I think that's should be the current focus.
All right, thank you for the answer, David. We will conclude the Q&A segment here. Thank you very much for the insights today, David and Josh, and thank you very much, everybody, for your time tuning into this webinar tonight. We will also be sending everyone a link to today's webinar so you can watch it again if you'd like to. Do visit our website, fluidfutures.com.sg or .my if you would like to reach out to us, or indicate in the post-webinar survey if you would like for us to reach out to you. That's all for today. Thank you, everyone, and goodbye.
Okay, thank you.
Thank you. Good night.